Money on my mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer some of the Ask James questions of the day. First question today, Craig. I'm retired. We're spending within our income. We feel okay. Does that mean we actually are okay? All right, Craig, great question. But it depends about how you're defining the word income, right? So there's really three definitions of the word income. There's cash flow, right? How much money your financial advisor is sending you on a monthly basis. Then there's the IRS definition for the word income. If all of your income is coming from a 401k withdrawal or an IRA withdrawal, well, then you get a 1099, and that's the IRS definition of income because you have to pay tax on it. But then, here's the investment-related definition of income. How much of your investment return is coming from interest or dividends? And Craig, this last definition is the one that matters most when it comes to not outliving your money. Now, we've talked about kind of before the US government and how they're borrowing $2 trillion a year just to pay the expenses. And, some affluent people do this as well, right? There are many billionaires that have a lot of appreciated stock and they don't want to sell the stock because if they do, they have to pay capital gains. If they die with the stock, that capital gain gets forgiven. It's a tax loophole, so to speak, right? So they'll borrow every year against the stock and pay some interest and spend down those proceeds. They're living off their balance sheet intentionally because they're making a judgment call or a guess that, hey, I'll die before I deplete this. And, they may be correct, but it's still a gamble. But realize these are billionaires we're talking about, right? Not millionaires, billionaires. So now you come in and say, okay, I've got a certain life expectancy, right? I don't know, what that is. So how much am I getting from just income? How much am I getting from interest and dividends? Because if that's your definition of income and you're only spending that, well, that's great. Because if you don't take any principal, then you really can't run out of money, right? It's almost impossible. You have to mess up pretty badly with investment decisions. Now, this is why I strongly recommend that retirees like yourself focus on building a true income portfolio, one that generates reliable cash flow from dividends, interest, and perhaps even some rental income, right? If you've kind of invested in real estate, right? Quality dividend aristocrats, right? Companies that have consistently increased their dividends for 25 plus years. It can form the backbone of this strategy. Similarly, a ladder of bonds with maybe staggered maturities can provide predictable income while managing interest rate risk. Think about it. If you're not getting your cash flow from interest and dividends, that means you're taking it out of principal. If you take it out of principal, then next year, what happens? Your interest and dividends, right? What happens? They go down, right? So because you have less principal. So now your interest and dividends go down, which means next year you have to, even take more principal and it becomes a slippery slope. And this is why, a few decades ago, the federal government was borrowing $100 billion a year, and now it's borrowing $2 trillion a year. Same kind of mathematics, just in reverse, right? A good exercise would be to calculate exactly what percentage of your spending is covered by true investment income versus principal withdrawals. If it's less than 100%, consider whether there are opportunities to shift more of your portfolio toward income-producing assets, even if it means potentially sacrificing some long-term growth. Remember, at this stage of life, sustainable income often matters more than maximum growth. Okay, I hope that helped. Great question. And as always, if you would like to send in your question like Craig did, you can do so by emailing them to poollocke@poollocke.com. Moving on to our second question from Taylor. Taylor's wondering, why is it that real estate is potentially a good inflation hedge when it's a long duration asset? All right, that is a good question about real estate and, can it be considered a good inflation hedge? despite being long duration, right? Well, it's a nuanced topic, so let's dive deeper into why real estate holds its own in the realm of inflation hedging, especially in the context of retirement income strategies focused on reduced risk and volatility. Real estate indeed qualifies as a long duration asset, similar to bonds or other investments that require a longer time horizon to realize returns. However, what sets real estate apart is its dual potential for income generation through rental properties and its status as a tangible asset with intrinsic value. Let's break it down. When you invest in rental properties, you're essentially, transforming real estate from a purely capital asset into an income producing asset. The rental income received on a regular basis acts as a steady cash flow or cash stream akin to dividends from stocks or interest from bonds, right? This consistent income flow effectively shortens the duration of the investment, providing a reliable source of income that can mitigate the impact of inflation. Now, even for properties that are not rented out but serve as, potential residencies or speculative investments, their value is intrinsically tied to the broader economic environment. Kind of as you correctly noted, right? The decision to purchase a home versus renting is often influenced by rental costs. When rental prices rise, prospective homeowners may be incentivized to buy, locking in their housing costs through a fixed rate mortgage and potentially saving on escalating rental expense. Moreover, real estate values historically tend to appreciate over the long term, generally keeping pace with or even outperforming inflation rates. Now, this appreciation in property value serves as a capital appreciation component of real estate investments, adding to the overall return potential. Now, it is important to acknowledge that real estate investments come with their own set of considerations and risks. Maintenance, right? Maintenance costs, property taxes, market fluctuations. However, when managed prudently as part of a diversified portfolio, real estate can offer stability, income, and inflation protection that aligns with the goals of retirees seeking to preserve and grow their wealth over time. So really, in summary, while real estate may be classified as a long duration asset, its ability to generate rental income and its role as a hedge against rising rental costs makes it a compelling choice for investors looking to kind of bolster their retirement income while minimizing risk and volatility. Hey, great questions today. If you would like to send in your question for us to answer, you can do so by emailing them to poollocke@poollock.com. And if you like what you heard today, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source. I'll see everyone next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank.